The global economy enters the fourth quarter of 2025 with a mix of cooling inflation, still sluggish growth, and a set of region-specific shocks that will shape markets and households into 2026. The IMF's latest outlook shows global growth remains below long-run averages as countries struggle with aftereffects from pandemic disruptions, tighter monetary policy earlier in the year, and renewed geopolitical strains. The United States is in a delicate spot. Policymakers have started easing monetary policy after more than a year of high interest rates to fight inflation. The Federal Reserve reduced its policy stance late this autumn, signaling a gradual shift from outright hikes to careful easing, while warning that labor markets and price data will determine the next moves. Lower rates are meant to support growth, but consumer prices and wage pressures remain close enough to demand continued monitoring. China, the world's second-largest economy, is a central wildcard. Official data show the economy expanded in recent quarters, but growth remains uneven across exports, investment, and household consumption. Beijing's stimulus and credit measures are aimed at steadying activity, yet weak global demand and a property sector still repairing balance sheets mean China's growth will likely be moderate rather than roaring back. That makes China less of a tailwind for global trade than it was in earlier recoveries. Energy prices and supply risks are another major factor heading into Q4. Oil markets have been volatile as demand signals from Asia and geopolitical risks, especially around Eastern Europe and shipping lanes, move prices day to day. Higher energy costs act like a tax on consumers and firms, tilting near-term inflation and fiscal pressures in energy-importing countries. Europe faces a mixed outlook. Some countries are slowly recovering after a difficult 2024-2025 winter, but inflation persistence and tighter borrowing costs have left fiscal room limited. Meanwhile, the ongoing war in Ukraine continues to pressure energy systems and budgets in the region, increasing downside risks to growth and financial stability. For households, higher energy and food costs remain the most tangible effect. A key domestic risk for the U.S. this quarter is political disruption. The prolonged federal government shutdown has already been linked to transportation and service disruptions and could further dent confidence in hiring if it persists into the holiday season. A reminder that political events can produce real short-term economic costs. For businesses and markets, watch three things in Q4: central bank guidance on rates and the pace of any further cuts, corporate earnings trends, especially in technology and energy, and consumer spending over the holiday months. For households, the immediate indicators to watch will be local job reports, consumer price releases, and any shifts in mortgage and lending rates that affect monthly budgets. Bottom line, the macro picture in Q4 2025 is one of cautious stabilization, not a broad boom. Monetary policy is easing in places where inflation has cooled. China's recovery is steady but not surging. Energy and geopolitics keep headline risk high, and political disruptions can still dent activity. That mix will keep markets alert and make incremental policy and business moves, not big leaps, the most likely near-term path. This has been your economic report from Straightwire News. No fluff, just the facts.